Good afternoon, everybody. Thank you for joining us in another edition of our Power Play Tuesday. My name is Andrea Chassin, and I'm an IRA specialist here at Quest. We're super excited today about our show. We have Dave Goldberg joining us and talking to us about investing in trust deed and mortgage loans. Very exciting topic and hot topic these days. So can't wait for that. Before we go ahead and get started as usual, let's go through some housekeeping. First of all, as a disclaimer, Quest Trust Company does not provide tax, legal, investment advice we don't sponsor any type of deals, products or services or investments. All information and materials shared here today are for educational purposes only, and every party is encouraged to consult with their accountants, attorneys, and financial advisors before entering into any type of investment. So for those of you joining us for the first time, Quest Trust Company is a self-directed IRA custodian company. And you may be wondering what a self-directed IRA is. The term self-directed is used differently depending on the custodian or on the company. We here at Quest use this term specifically so that you know and understand that you're going to be investing your IRA funds into private investments, alternative assets, they're also called. However, an IRA is an IRA anywhere you go. It has the same rules, the same restrictions, the same contribution limits. The only difference, depending on the custodian, is going to be what kind of assets you're going to be able to invest in. Okay, your more typical custodians, more traditional custodians, the bigger ones, typically only allow you to invest in the stock market. We here at Quest allow you to invest in the private market. What are some examples of private investments? We have real estate. This is basically our bread and butter, what we specialize in. Our clients bring over their retirement funds through IRAs, and then they can invest it in real estate. For example, they can purchase property, residential, commercial. They can do fix and flips. They can do wholesaling. They can buy improved or unimproved land. They can also buy shares in a limited liability company and an LLC, as long as it's private. They could do cryptocurrency. They could do real estate trusts, as long as they're private again. Also, another big one that we do and that our clients do participate in is promissory notes. So basically loans, whether they're secured or unsecured mortgage loans, which I'm sure they will talk about today. That's also another very popular investment choice for our clients here at Quest. If you have any questions, if you'd like to schedule a call, a complimentary consultation with one of us, IRA specialists here, we'd be happy to take you through the process, to answer any questions you may have. We know this can seem a little complicated, or maybe you have a lot of questions at the beginning. We're happy to walk you through those, walk you through the process, etc. So feel free to scan this code and book something with us so we can talk about it. Right now, we are promoting this promotion. It's basically once you open an account with us and when you move over funds, sorry, my phone's ringing. Hopefully it's one of you already calling us. But whenever you move funds over, you get a credit, whether $125, $250, or $50 or $500, into your accounts, depending on how much money you move in. And then you also get a free expo ticket, which we're featuring right now. We're super excited about our Quest Expo happening at the end of June. We hope to see you all there. It's going to be in the area of Dallas, specifically in Irving, Texas. It's going to be awesome. We're going to have upwards of 800 to 1,000 people there, lots of sponsors, lots of education, and of course, the unparalleled networking that you'll be able to experience there. So go ahead. If you want to just get the ticket, you can still use this code to get 50% off on that price there. But without further ado, let's bring up Mr. Goldberg here so we can go ahead and get started with today's presentation. One moment. Hi, David. How are you?
Good, Andrea.
Thank you for
Thank
being here
you.
with us. Go ahead and take it away whenever you're ready.
Okay. Thank you so much. Great to be with everybody here today. As Andrea said, this whole world of investing in self directed IRAs can seem very complicated. And my goal is to help simplify at least this option of investment opportunity in your self directed IRA. Just a little bit of background about my company. This is, well, first of all, an educational webinar. So there'll be no sales pitches today. But just so you know a little bit about our background, we have been making private loans for about 12 years now. We lend with our own money. We also broker deals with private lenders. And about 5.5 years ago, we started a pooled lending fund. And I'm going to talk about all of those options in this presentation. I'm not going to get into returns much at all, or how much you can make. Very happy to talk about those things with you if you wanted to give me a call afterwards, and we can discuss anything in detail, whether or not you ever do business with my company. I'm very happy to work with you and answer any questions that you have. So we got a lot to cover. We'll jump right into it. And thank you again, Andrea. And please do put your questions in the chat. We will wait till the end to answer. I'll get through every question. I'll wait. I'll go as long as we need to make sure we've answered all of your questions. So without further ado, here we go. Real estate-backed lending with trust deeds. What are trust deeds? Many of you know this, a lot about this already. So if I'm going over information you know, please forgive me, but we'll start right from the beginning. And trust deeds are loans, also called deeds of trust or mortgages, and they are commercial loans secured by real property, generally for things like flips. We're lending to investors and builders and anybody who needs a loan for commercial purposes. You will also typically hear them referred to as private loans or hard money loans. Most trust deed loans that you're doing do not involve owner-occupied properties, and I recommend strongly that you do not make loans on owner-occupied properties. It's just a whole slew of regulations that goes along with that. And a typical example of a trust deed loan or a hard money loan is someone coming to you, or more accurately to your IRA, because we're talking about investing in your IRA. They need $100,000 to purchase a property that needs some work. They need $50,000 to do the repairs. Then they might turn around and sell it in 6 months to a year for $250,000. They walk away with a $100,000 profit. And you, as the note holder, walk away with interest that you're earning every month on that loan. So it's a great deal for everybody. Almost always, these kind of loans are in the first position. You can choose to make loans in a junior position, but you have to be very careful about that. There are inherent risks involved in a second position loan. And by the way, our relationship, we have no relationship with Quest. We are just, again, providing education and are one of many different brokers that you can work with if you choose to work with a broker to do your investing in trust deeds. And you'll see you can do them by yourself as well without a broker, and I will be talking about that. The loans are short-term, usually 6 months to 12 months, sometimes going as long as 18 months, or you may choose to go even longer than that. But they're short-term because basically you're lending money for them to get in, to fix up the property or to build it from scratch, or to get temporary bridge loan financing until they can get permanent financing in place. And then they either sell the property or refinance it with long-term financing at typically better rates than you can offer, and you're out of the loan. Higher interest rates, because they are short-term, banks in general won't touch properties that are distressed and need rehab. So the market dictates that you can charge higher interest rates, and your borrowers in general are going to be very happy to pay those because they can get these loans quickly and do what they need to do to make a really nice profit. And as I mentioned, the loans are repaid by either flipping the property or refinancing it. You could choose, again, to go long-term with a loan, but in general, trust deed investors want to keep turning their money over, making additional origination points, which I'll talk about, and getting in and out of a loan, the quicker the better. The longer you're in a loan, the more likely that it is that something could go wrong. So you would like to get out of it sooner than later. So why do investors like to invest in trust deeds? Many really good reasons, many more than I can go through today, but I'll start with the basics. First of all, the note rates that are charged by lenders, they can be anything. They can actually start as low as 6% and go higher than 14%. That doesn't necessarily mean what you're going to make, say, over a year, but it is what the note will return. And of course, the higher that note rate is, the better it's going to be for your return. So again, investors are happy to pay higher rates to get this kind of money. You also get a security interest, which is kind of rare in investing. Of course, if you invest in real estate, you have the security of the property. And investing in these trust deeds, all of the loans are secured by real estate. So if something happens, you have the property to back it up. As I said, finding a secured investment, of course, if you're in the stock market, you really have nothing backing up that investment. So secured investments are hard to find. And that's one of the beauties of trust deed investing, is having that security just in case things don't go as planned. And there is liquidity. So there's a couple of ways you have liquidity. There is a monthly note payment being made every month, which could be an income stream for you in your IRA. And also, unlike some, say, real estate investments that you might invest in, or a syndicate with other people, you might have to wait a few years to get your money back. And that's great if you have that kind of time. But people like trust deeds because they circulate, they turn over, usually within 9 months to a year, and you can get your money back. So you're not tied up necessarily for that long. And even in a pooled lending fund, depending on what their lockup period is, you usually can get your money out at least within a year or so, so you have it available for other purposes. In an appreciating market or a depreciating market, it is an appropriate investment. Obviously, you'd like the market to stay strong and prices to stay high. But even in a depreciating market, if you have built in a proper cushion, say 25 to 30%, if the market drops 10 or 15%, you're still covered. Whereas if you're investing in real estate directly, if the market drops, your investment goes down. So that's a very nice thing about trust deeds. It makes sense from a tax standpoint. Your money is going to grow tax-free in your IRA, and you're going to get advantages in your IRA that you might not get outside of your IRA. So it does make sense from a tax standpoint for certain. Your return is taxed as regular income. And if you use a broker or invest in a fund, you also get professional management. So you get people who are hopefully doing this every day and have been through the many different challenges that these type of loans bring. And I'll talk about those as well. So it's nice to have a layer of management if you go that direction. And I'm tempted to put this last one at the top, which is investing with a purpose. meaning you're not just throwing your money into a mutual fund in the stock market, but you are putting your money into projects that help communities look better, provide housing where there are housing shortages. Just in blighted communities, your money is making a difference. And I can say from what I have seen working with lenders over 12 years, I think the people we work with really like to see that their money is making a difference, and it's not just going into something they have no idea how it's really being invested. And you'll know how your money is being invested. I'm going to go through 3 ways to invest in trust deeds. There actually are more than that, but these are the basic 3, which are making loans directly yourself or through your IRA, not using any kind of broker. Same thing, using a broker. And then you can also invest in a pooled lending fund. And I'll talk about each of these. So making loans yourself, generally you're talking, as the example I gave, about loans, say up to $500,000, because most of us don't have much more than that laying around to invest in one deal. That classic fix and flip example I gave you is a typical loan that we see coming to us that can be funded individually by one person. And some of the advantages of doing these loans on your own, not using a broker, not going into a fund, arguably the most income potential because of the points that you can charge and keep. So if you're working with a broker in general, a broker is going to work on keeping the points, and then you would make either the full interest or at least a lion's share of that interest. If you're making loans on your own, you can keep those points. And a point is the percentage the borrower will pay up front, usually between 2 and 4 points, for you to originate the loan. If you are making those loans, don't short yourself by not charging those points. I do know lenders who do that, and they really are leaving money on the table. Very acceptable to charge an upfront fee for the work you're doing to originate the loan. So on a $100,000 loan, you can make an additional $2,000 to $3,000 very legitimately, and borrowers know that that is a standard part of the industry, just like in a bank, and maybe a little more than a bank, but it's okay. Most control over loan choice. You can choose the loans that you want to fund. That's always a good thing. Whereas in a pooled lending fund, you wouldn't have that choice so much. Hopefully, the fund manager will keep you posted on what loans they're making, but making them yourself, you can choose which loans to fund. You're building a business, so as time goes on, you'll have your own network of people who will seek you out. And once people know you have money to lend, eventually they're going to find you, and you won't have to rely on a broker. And as I'll talk about with a broker, there's nothing that says you can't do both. Use a broker and do loans on your own. All of these in an IRA, by the way, are definitely doable. But doing it on your own, you don't have to rely on a broker sending you deals, and you will be competing with other lenders with that broker. So great to have your own business streaming in as well. And a lot of investors just like the security of having their name, which is actually, if you're lending in your IRA, your Quest account name will be on the promissory note and the deed of trust directly, either when the loan is originated or, if you're making that loan, it'll be right on that note and deed of trust right from the get-go. And if something happens, that's the easiest for you to try to use that property to get back your investment. And as compared to a pooled lending fund, often those have accreditation requirements, and you wouldn't need that to make your own loans. Advantages of working through a broker. You're going to have many of the same advantages of doing it on your own and some others. So you get the benefit of that professional management. This business, making loans, if anyone here has done that, which I'm sure there are, you can see there are just many, every loan is very different. We've done over 300 loans since we've been making loans, and there are really no cookie cutter loans. Everyone has little quirks. So we've seen them all. We have made mistakes. You will make mistakes, but hopefully if you're working with a broker, they have made them already and they can avoid making them again. Huge one is using a broker. It will definitely save you a lot of work and a lot of time. There, as we'll get into later on, there's a huge amount of due diligence that goes into doing a loan right. That's due diligence on the deal itself, on the borrower, and there are just countless number of steps working with title companies, doing loan documents, draw processing, because many of the loans are going to involve rehab or construction. And you can choose which ones you're going to do, but all of these take a lot of time and there are a lot of steps to do them right. And a broker is going to do those all for you. And I took a class on hard money lending right in the beginning and came out with a loose leaf notebook that was literally about 10 inches thick. And most of the lenders in the class decided, yeah, I learned how to do it, but do I really want to do all that work? So it's something you have to make a choice about. Again, you can actively participate in the loans that you want to fund. The broker will present to you the available loans and you can choose which ones you want to lend. And if you don't want to, of course, you don't have to go into that loan. And with a broker, you will get your IRA name on the note and deed of trust as well. So it has that advantage. And it'll increase your deal flow. Like I said, if you're doing them on your own, a broker can help you get more deals as well. And compared to a pooled lending fund, you will have more control than what the fund manager is choosing in that fund to fund. And no accreditation requirements. A broker will ensure that you have some investing experience so that you're not over your head, but there will not be an accreditation requirement working with a broker. And there are definitely advantages of lending in a pooled lending fund. A pooled lending fund will consist of loans of the type that I mentioned, construction loans, fix and flip loans of all different sizes, depending on what the lending fund specializes in. But an advantage of a pooled lending fund is that with pooling money together from investors, there are more options to the fund manager to make larger loans and participate in deals that otherwise could not be funded with one investor. For instance, a self-storage project building 20 self-storage units that might be $1 million plus loan amount required. And with a pooled fund, you can make that kind of loan. And obviously, there'll be a much greater limitation for finding individual lenders to make that kind of loan. So there might be more opportunity in a pooled lending fund. Again, you get the professional management. It's the most passive. So investors like the idea of putting their money in, not having to worry about making decisions. And again, hopefully your fund manager will be communicating to you what the investments are, how the fund is doing, and not just leaving you in the dark. And I have found that investors appreciate that as much as the return they're making, sometimes even more, that level of communication. You get great diversification in a fund because when you invest in a pooled lending fund, you are actually investing in all of the deals of that fund, both the ones that are already in there when you join and the ones that will be funded after you become a shareholder. So there's a lot of diversification and a sharing of risk. If one loan doesn't perform as expected, that can be made up by the rest of the loan. So it's kind of if there is some kind of loss to the fund, it would be spread out amongst all the shareholders. And hopefully you're not in a fund that's realizing many, if any, losses. And one thing that investors tend to forget when they invest on their own or through a broker even is when you're funding your own deal, it's great and the returns that come in are great. But then between loans, there's invariably a down period. It could be a day or it could be 6 months before you find your next loan. And that goes to affect your yearly return. Whereas in a pool lending fund, your money is invested all of the time. So there is no downtime. And it's great to have that money working all of the time. Counterintuitively, it's often the lowest required investment. Sometimes many funds require that you be an accredited investor, which you would think would mean you have to invest more money. But the fact that the funds are pooled together means the fund manager doesn't necessarily need a huge investment from everybody. Fund investments can be as low as $50,000 or even less sometimes. With all that money pooled together, deals can be funded. Whereas if you are funding a deal on your own or through a broker, in general, you're going to need $100,000 or more to invest. And in a pool lending fund, it's often lower than that. Okay, and yeah, if you have any questions about advantages and disadvantages, please put them in the chat and we'll answer them at the end. As I mentioned, a really huge part of doing loans correctly and protecting yourself is mitigating the risk, and that's through the due diligence that you do. And I'm sure you've heard this before, which is do your due diligence. So we're going to talk about the major due diligence steps you can take to make sure that you are protecting yourself. I'm going to list some of the risks involved and then how we address those with the due diligence that we do. And when I say we, by the way, I'm not just referring to my company. I'm also referring to all trusted investors out there who are doing things the right way. Starting with, so here are the risks. Valuation of the property is a huge one. If you start off immediately not valuating the property correctly, you could be in big trouble. So especially, of course, if you overvalue a property and lend too much on it. And the way to protect yourself against that is to, well, visit the property, get an outside valuation, either with an appraisal or a broker price opinion, and your borrower will pay for that. So that's an accepted part of the business. Do a property visit and just make sure that you are getting all the information you can to not overvalue the property, which is going to determine how much you lend on that property. The budget is another one. If you are making loans for rehab or construction, and if you decide not to do those, you're definitely going to limit your availability of loans. So even if you start off not making these type of loans, you probably will evolve into making those. And having an adequate budget is extremely important, especially with someone who doesn't have a whole lot of reserves behind them in case they misjudge the budget. So you need to look over the budget very carefully, look at the cost per square foot numbers, cost per hard cost per square foot numbers. And we've learned that having a budget meeting, going through every line item, line by line, to make sure they have thought through every aspect of the budget, really important. So one way or another, whether they are providing the whole budget or you are providing all of it or a part of it, make sure there is going to be enough budget to get the project done. You don't want to get to 3/4 of the way and run out of money, especially if they don't have any money to put in after that. Make sure there are no title issues involved. You definitely want to get title insurance when you're making a loan, and just make sure there's clear title on the property. And always keep an eye out for market changes and know your market well. I would suggest, if you are making loans on your own, stay in markets that you're comfortable with. Don't go out too far until you get to that comfort level, and know what's happening in that market. So there are services out there you can use, like Home Facts. You should talk to as many people in those markets as you can to find out what's going on. Is the market improving? Is it slow? Is there a lot of crime in the area? You want to know what's happening before you go into that market. Okay, and speak to real estate agents, anybody that you can, to get a handle on what's happening in that market. So you also want to screen your borrower. To me, the days of making trust deed loans or hard money loans, it used to be said you're only lending on the value of the property. You don't even have to worry about the borrower. I don't know too many lenders who go by that anymore. I think you want to know who you're dealing with. If you're not feeling comfortable for some reason, listen to that. And I would suggest make loans to those that you have a level of comfort, you feel good about them. Trust your gut and your instincts, and do the following as well. Make sure you look into their credit. I don't think credit score itself is hugely important, but it does tell you something. It's more that you're looking for patterns on their credit history. Are they the type that if they can get away with not paying their bills, is that what they're going to do? Well, they will probably try to do that with you, even though you have that property. You just don't want to get into a situation where you're working with someone who's not a good person. And do a criminal background check if you can. Do social media checks as well. I like to tell the story of a woman. This is probably my first 6 months in business, who came to me for a loan. I did a social media check, and it turns out she had charges in her past that she and a boyfriend were accused of murdering her husband, and whose body was never found. And she got off, but there was a well in her home that was filled in with concrete, and that she got off. But of course, we made the loan. We charged her a few extra points, but no, only kidding. Do as many checks as you can. Know who you're dealing with. Meet the borrower if you can. If you can't, definitely in the beginning, you do want to go to the property, check it out, meet the borrower there, check their references. If you can't meet them for some reason, do a Zoom call with them. I like a face-to-face meeting to really know who you are dealing with. And as I said, especially when you have a budget involved, make sure there is adequate liquidity on their part to make their payments monthly, to cover any budget overages that might arise. And we have found that liquidity is becoming more and more important. I'd much rather work with someone who has the means to cover the unexpected, because you just never know what's going to happen. And if you're working with a broker, definitely do your due diligence on them or a pooled lending fund. Look for their experience, track record, what kind of history they have with making loans. Do most of their loans pay off? If they have, how long they have had their fund for and how long they've been in business. So all those things really count. Work with someone who is willing to tell you the good and the bad. They're transparent with you. They're not going to hide things from you if things don't go right, and they will work with you to make sure that the best solution is is going to be implemented when things don't go right. So it's great. Everybody's great when things go right, but you want to be able to work with somebody who is going to be straight up with you when things don't go so well. That's important to lenders. Make sure they have a good reputation with both borrowers and lenders. It's great that they're nice to you as a lender, but if they're not treating their borrowers well, they're going to lose their deal flow, and you're going to be working with someone who is not going to be able to supply you the stream of loans that you want to keep your money working. So make sure they have a good reputation. They're humble. They're, as I said, loans in this industry are so different. Make sure they're willing to learn from each of their loans and get help they need if they're going to venture into something new, and they're not afraid to admit when they don't know something. Make sure they have a strong team behind them who have stuck with them and are working with them to provide support for you, because there is so much required to do a loan correctly. Skin in the game is important. If you're working with a fund manager, it helps that they are invested in that fund, and they're going to, if something goes wrong on an individual loan, possibly be there to help you, even with their own money, make sure that you're made whole. So make sure they're personally invested as well. And then, as I mentioned with market forces, very important to keep on top of the market. So right now, there's lots of things going on that do affect our industry and your ability to make good loans. I'll go through a few of them here, and maybe you have some questions about these when we get to the Q&A. Right now, we have been dealing with higher interest rates for the last couple of years. Those don't look like they're going anywhere in the near future. So that has definitely reduced investor activity. It hasn't shut the flow by any means. It's still really good deal flow, but it has put a little bit of a damper on it, so it's not as robust. So the whole market, real estate-wise, there's just not as much activity going on, which puts downward pressure on prices. And also with those higher interest rates, it makes it harder for borrowers who need to refinance as their exit strategy to get those refinances done, because the rates are higher and banks are more, they're just very particular with who they're making loans to, and finding a loan that makes sense to refinance has just been harder for our borrowers. But most of them eventually do find a way to make that happen. There, as we know, there's a housing crisis in many areas around the country. Colorado is notorious for needing additional housing, and there are supply issues with the amount of housing available. So on the plus side, the lower amount of housing that's available, that's going to put upward pressure on prices, which keeps the loans and the collateral backing them up stronger. And it also, with fewer houses available to buy, when borrowers need to either refinance or when they need to sell their properties, the fact that their property is on the market in a low supply market, there are going to be more buyers available for that takeout. So that helps our loans get paid off. On the minus side of supply issues, lower supply means higher prices, and there are fewer deals for investors to make a good profit on. So that cuts down on deal flow. And also, governments tend to want to get in there and fix everything. In my view, that's what's happening here in Colorado. And I'm not sure what the climate is down in Texas, if there is that same kind of government regulation, but it sometimes makes it harder for investors to make a successful investment with all of the red tape and legalities that they have to maneuver around. So keep an eye on what your state legislature is doing with housing regulations, because it can make it cumbersome for investors to make a profit. Inflation is definitely making hard assets like real estate more desirable, so that's good. Trust deeds, even though it's not directly real estate, that paper that is being secured by real estate in effect is like owning real estate. So trust deeds can be a great hedge against inflation, that they are not going to lose their value. You have that asset which will, as inflation goes up, prices of real estate generally goes up as well. So that's going to make your trust deed investments even stronger because they're backed by something strong. Immigration, the jury's kind of out on what the immigration situation and its effect is on the real estate market. On the positive side, more people in an area is going to mean greater demand, and that's going to push prices up. And if cities do get overrun with immigrants and it's causing quality of life to diminish, there could be, and we're seeing in certain cities, people leaving, which is going to put downward price pressure on real estate, and that can have a negative effect to a certain degree on your trust deed investments. So we just got to keep an eye out on that one. If you do want to get started, and hopefully at this point you are very excited about trust deeds, because I think it's a fantastic investment. There's just so little downside to it in my view, especially if you're doing that due diligence. Give it a shot. So getting started, if you're interested, find a lending opportunity. You can go to, if you're going to be doing it on your own, start going to investor meetings. Just get the word out there that you are making loans. Word will spread. If you can do a website, that's great. People will start to find you, get that first lending opportunity, and go from there. Make sure you do your due diligence. You have to have really good loan docs, so I definitely recommend work with a good attorney to get those loan docs in place. The basic ones you're going to need are a promissory note and a deed of trust or mortgage, depending on what state you're in. There are other documents you should have as well, but those are the basic two that you need to get going. You have to find a title company. Now, if it's a sale of a property, usually the buyer and the seller are going to pick a title company. But if you're doing a refinance, you may have to find the title company. You're going to have to find one that's kind of on your team, get title insurance, get a closer lined up, contact Quest and inform them you will need funds available, that you're either doing it on your own, working with a broker, or going to be investing in a pool lending fund. They will get you set up. They and the broker, if you're working with them, will get you set up with all of the paperwork that needs to be filled out to make this type of investment. And then close the loan. I think I have come to the end of my presentation here. Thank you for hanging in there with me. I know it's a lot of information to absorb, and I'm very, very happy to answer any questions that you all have right now.
Thank you, David. That was wonderful. Thank you for all the valuable information there. Oh, there's my phone again ringing. Sorry. Thanks so much. That was awesome. We don't have any questions yet posted in the chat. I do have some internal questions that came up here. The first one is, how long are the cycles when investing in a fund typically? Do they vary, and what's an ideal time frame to invest?
Yeah, that's going to be very dependent on the individual fund. The time frames that I have seen range anywhere from a year. If it's a if it's a trust deed fund, private loans, generally I've seen a year to 2 years. If you are going to be investing in a fund, I know this is a different topic, but say a fund that invests in real estate itself, and generally you do that on a per project basis, those can go 2 to 4 years. But generally with trust deed funds, you're talking a year or two, depending on the parameters of the fund.
Excellent. I do see a question came in from Joe Bixby, and it's, where are you located? What markets do you perform deals in?
My particular company, we're located in Loveland, Colorado, about an hour north of Denver. Our primary area is Colorado and Wyoming, but we are also open. We're registered in, I think, 4 other states that we do a little bit of business in, but we try to keep our focus locally right now. And that's what I would recommend if you are working with a broker. Not that they can't go nationwide, especially if they've been around a while, but make sure that they are comfortable in the markets that they are lending in and not getting too far ahead of themselves. So you want them to be protecting your interests and making sure they're investing where they're comfortable.
Excellent.
And I'm happy to answer, anything more about my company. Probably best to call me directly or email. I won't give you a sales pitch. I'll answer your questions and about trust deed investing in general. And if you want to know about what we do, happy to talk about that too.
Excellent. Thank you. What's a good fee or fee amount that a fund can charge for their services? What do those look like generally?
In general, when you go into the fund, all of the income generated by that fund, which is going to be the interest from the notes, the origination fee, which some funds include in their waterfall and some don't. Some keep them for themselves. Then you've got extension fees, late fees, administration fees, and like rehab administration fees. They all go into the fund, and from that there are general fees deducted. Hopefully the fund is going to keep those extremely low, including not use their marketing dollars from the fund, but from their own money. And then from that, there'll be an originator fee paid out to the loan originator, which is generally the broker that you're working with or the fund manager, and then a management fee to the fund manager. So when all is said and done, you want to make sure that your return is pretty close to what you would be getting, or sometimes even higher than what you'd be getting if you were investing in a trust deed on your own. So I guess the short answer to that is going to be, it depends on the fund, but management fees are going to range from 1% to 2%, and the fund originator fee is generally going to be between 10% and 20%. Those, I believe, are pretty standard numbers for the industry.
Thank you. I know you touched on due diligence, particularly on a fund, but are there any documents we should be asking specifically the fund to provide us with when we're performing due diligence on them?
Well, if you're working with a fund, they're a legitimate fund, which most of them are, but they should have an offering document, a private placement memorandum that is going to be one of the first things that they're going to send to you. That's a whole 100-page document sometimes of everything involved in the fund, and including all of the risks. So make sure you get that. That should include a really good summary of all of the parameters of the fund, what the lockup period is, what the minimum investment is, what kind of assets the fund is going to be investing in, and all of the expenses of the fund. Those should all be disclosed. There should be absolutely nothing not disclosed to you as the investor, and that's going to be your main document. Within that is going to be a subscription agreement if you want to subscribe to the fund or make your investment in the fund and the operating agreement. And I believe there is a Q&A in there, and I believe that is required by an exempt fund, which most of them are going to be. And exempt means it's exempt from SEC registration based on the investors that go in the fund. And that's why where the accreditation requirements kick in, the exempt offerings are going to be made up of either all accredited investors in that fund or a large majority of accredited investors, which the SEC exempts from its registration process because it's trying to protect investors who are not as experienced, let's say, and don't have the resources necessarily that an accredited investor would have. So hopefully I've answered that question.
Excellent. Thank you. Where do you source your market forces and trends from? What do you use for maybe Google?
Well, I mean, honestly, I think most of those they're pretty general, the ones that I have mentioned on that slide. So I'm basically going by we have a staff meeting every 2 weeks where we do go through market forces, and trends are a big part of our meeting. So we just started that a couple of years ago, saying that what's happening in the market is very important to our business. And if we're trying to operate outside of that, we're not doing a good job. So we make sure that we are staying on top of factual information that is happening out there. I wish I could cite to you the exact sources that I'm using for that, but we know we're in a period of inflation. We know we're in a period where interest rates have been higher. We know there's immigration going on, and those effects that I mentioned are fairly high-level effects. So those are the sources that we are using, and we do make sure that we are using very factual information
Excellent.
from the market forces that we're looking at.
Excellent. Well, that takes us to the end of the webinar. I don't see any other questions posted in the chat. If anybody has any questions after watching and would like to contact David directly, go ahead and do so with the information on the screen right now. Thank you again, David, for being here, for joining us. Hopefully you can come again and talk in one of our webinars in the future. But yes, with that.
I would love to, Andrea. Thank you. Thank you all for being on today. I wish I could see you all. That's one of the drawbacks of Zoom, but great to be on with everybody. And
how about we all meet at the Quest Expo at the end of June?
That's a great idea.
Let's do that. All right. Thank you, everybody. Thanks again, David. Have a wonderful rest of the day, everybody.
You too. Thank you, Andrea. Thank you all.
Thanks.